you consult and advise both types of startups, all different types of startups. So what do you see as the difference between raising funds for CPG? How do investors react differently? How should founders act differently? And raising funds for, let's say, something like a SaaS?
SaaS is a lot easier. Come right to it. Especially in the last 5 years. I mean, the margins are incomparable, right? So if you build software and you've got a SaaS model, you just have these explosive margins once you establish yourself, and investors love that. Who wouldn't? Especially if you've got institutional money, venture capitalists on the cap table. With CPG, it's about, really penetrating an existing market. And there have been great brand disruptors in big industries, thinking about footwear, like On Running, for instance, a great example. It's a startup that has now dominated a lot of the footwear market. But investors generally a little more cautious when it comes to physical products because of those upfront costs. And also customers and online consumers are so picky these days. And it's really hard to know if a physical product and brand will have staying power, or if it's just sort of like a one-off fad. And sometimes investors like to wait that out a little bit to see that there is a real market stake that a CPG brand can take before they want to jump in with their capital.
If you look, let's just talk about Soulmates for a second and use you as an example. What were your margins on that? Just don't give us the gory details, but just generally speaking, what are your margins there?
The gross margins were very strong. We always had US manufacturing, but it was more about the customer acquisition. So how much are you going to have to spend to acquire a customer, and then what's the lifetime value of that customer? And with Soulmates, we had an initial product that was unique. We had patents on the high heel protector. No one else was doing it. So that was a great inroad to getting that customer acquisition. And then we expanded the product offering to be able to increase that average order value. So we actually had very strong margins, but not every brand can do that. If you don't have something completely new and innovative, let's just say you're a new sneaker company or a new fashion apparel brand, you really have to make a compelling case to your consumers that this is a product that they want to put their dollars behind. And that can be hard because of the changing tastes that the consumers have. And then also looking at the channels on how you're acquiring those customers through social, through paid digital, it becomes very hard to have a positive return on that investment.
Yeah, I see CPG companies, like if you're at 30% margin, it seems to me you're doing pretty good. Now, I don't have a lot of experience, but just the ones that I've invested in or have worked with, like pet food or, different things like that. But then let's talk about pets for a second. We were looking at some investments in pet insurance, which was all delivered digital, let's do digitally, et cetera. And those margins were like 70%, 65%, right? And so it's so much easier to scale. But if you can do it right, a CPG company has such staying power. Like you look at all these product companies, and once you have that brand and people are wearing the brand, you can expand the products like you did. But also you think about like Crocs, who would have thought? And now I see Crocs in all different shapes and sizes, and it's become like a cultural thing. And all they do is make those funny, foamy footwear thingamajiggies, right? But they've done so well for themselves, and they're so entrenched now that they're a private equity play. Like private equity, like CPG companies get gobbled up by private equity all the time. I would say more than VC. Private equity company will come in, family offices, different places like that will invest in CPG.
All the time. And part of that is because there is scale, to your point, and also global distribution opportunities if you become acquired by a PE company. Also, the nice thing about CPG is that it's not going to be taken away by AI. So
that's true.
Let's be honest, if you've got a software company and you've developed something that's been really working for the last 10 years, you might be in a situation where you're going to have to really innovate in order for you to stay relevant if AI could potentially take you out or make your service or your software obsolete. CPG, you don't really have that. People are these big categories in terms of clothing and footwear and food and pets and these things that are tangible. They're not going away. They might be improved or enhanced through AI, and there may be additional innovations. But at the end of the day, unless you take the belief that we're all going to live in a virtual world someday, then there's always going to be space for CPG.
For sure. I think it's just so much harder. Well, everything's getting harder to break into these days. But I look at the attendees that we've got in our audience and just being familiar with them. A lot of them are working on CPG, physical products as well, like a hardware type product, or some type of physical infrastructure required to deliver the product. How does an early stage founder approach fundraising CPG? What would you say is the secret? Actually, let's back up. Did you raise any money at all for Soulmates?
Yeah, absolutely. Multiple rounds, yeah.
Great. So what's the advice that you would give for our founders there who are trying to raise money to make a physical thing?
You have to prove that people will buy it. And whether you have sales, and you bootstrapped and maybe you've got some sales, whether it's 10,000 or 100,000, but if you have some actual financials that you can share, that's a great starting point. If you don't, you need to make a very compelling case that this is a new product brand that doesn't exist and the market is big enough and you're going to be able to acquire those customers in an efficient way that's believable, that the investor can understand how they're going to get their money back, because that's what it comes down to. So traction, I know we talk about that all the time, especially in the raise environment that we've experienced over the last 2 years. Good news, it is improving. Interest rates are coming down.
It's improving.
There will be a lag. So, it's not like the gates are just going to suddenly open and there's going to be tons of funding for all these startups, but you need to really make a compelling case. And ultimately, your investors are investing in your ability to execute. You believe in your product, do everything you can to make it as strong as possible. IP, figure out the go-to-market strategy, do early testing, do betas with your customer base. You can really have data that indicates there's a strong likelihood to buy, but your investors are going to be betting on you being able to execute that. And be clear with your projections, be very realistic with your projections too, and test them. We have the nice thing about now, especially with AI and all the different tools we have at our disposal, you can really test your hypothesis about how am I going to acquire these customers? Can I build a community? Can I build loyal fans around my brand? You can do that and actually get really insightful data that will then make your case that much more compelling to your investors.
Okay, but what about the founder that says, but Becca, I need to raise money to actually go out and prove and test and get customers and build my prototype. It's like the whole chicken and egg. The other day, I had a comment on my personal YouTube channel, and they were saying, Ed, it's kind of like you're saying startups have to be successful first before they raise money. And part of me says 100% absolutely, because investors want to come in to something that's more of a sure bet. And if you've already established initial amounts of success, and you can show that your money is just pouring gasoline on the fire. The fire's already lit. It's already burning. We can make this happen. But I do acknowledge that there are cases where founders need money to go out and test their hypotheses. What would you say to that founder who's in that chicken and egg with CPG?
I understand. And it is absolutely a very real situation that a lot of us have experienced. So first is you have to get really clear and honest with your numbers. What do you need? What do you really need in order to get that product made, in order to get, even if it's a small set, 100 products, 20 products, whatever it is, what does that cost? And I think a lot of founders, they don't want to take the time to do that research and think, what is my bare bones MVP in software terms? What is my bare bones product that I can bring to market or bring to a private beta situation to get that proof that there will be the customer buy-in? So that's number one. Number two, you have to be resourceful. And guess what? Resourcefulness is going to be a characteristic you will need throughout your entire career as an entrepreneur.
Absolutely. Investors look for that too.
Look for that. In fact, when you have a challenge, whether it's on the fundraising side or the manufacturing side, embrace it, because that will build that resourcefulness muscle in you, and you're going to have to really use that throughout your career. So just being resourceful. So what does that mean? Well, you could look at crowdfunding. Again, knowing what that number is, let's say it's $100,000. Crowdfunding might be a great way for you to raise that and get those initial customers. Maybe you've got a full-time job. Can you save a little bit of money every month to put into the fund to help you get that $100,000? Do you have a small group of friends and family that would be willing to invest in you, maybe as a convertible note or as a safe? Something that will give you a little bit of that extra financial resource to get to that next step. But that comes back to just being resourceful, and you have to be honest with yourself. And how bad do you want it? There's a great book. It's called How Bad Do You Want It? And it's about athletes and performance. And it's really interesting. An example from that, for many, many years, it was thought that a human being could not run faster than a 4-minute mile.
Yes.
And for decades, people tried, and yeah, there were innovations in some footwear and like uniforms and tracks and weather optimization. But until one person did it, it was like all of a sudden all these other people could do it.
Yeah.
And the human body didn't change that much, but it's just knowing that it's possible. And so that's another thing as a founder in that early stage when you're struggling, it's possible. We've a lot of us have been in these difficult situations, but guess what? You can get through it. You just have to start thinking creatively and being resourceful. And that's one of the values of startups, in my view, this community where we become such a helpful collaborative community to help each other through these situations.